Hello, and welcome to Macro Mondays. My name's Harry Nedeljkovic. I'm a research analyst here at Onyx Capital Group. So we've got a lot to discuss this week. Last week we had a huge amount of data. We had Germany's IFO business surveys data for June, which came in much weaker than expected. It was meant to be 89.7, but lowered to 88.6. We have the US Conference Board consumer sentiment data for June, and we have US new home sales, which also came in weaker than expected. The really crucial thing, which I'm sure anyone who's watching this will have been aware of, was the US the first presidential debate on Thursday, which we'll get into later. There's a lot to talk about with that specifically, but I don't think we're going to have a shortage of things to discuss.
Yeah, and thanks, Harry. One thing I would pick up there was the new home sales. Impact you're going to have there, firstly, is negative impact on construction jobs. We have employment data this week, key data in the US. The other thing, it has a negative impact on lumber prices if we want to look at commodities. Also, at the end of last week, we had the PCE inflation data, which is the Federal Reserve's favorite metric. That came in as expected, 2.6%. No negative surprises to shock the central bank there. And over the weekend, we also had Chinese ISM data. Actually shows more contraction, which is a concern again for the global economy.
So something we've been seeing in the past week, really a continuation of a trend that's been seen for a while now, is a further devaluing of the Japanese yen. So the yen has essentially devalued below 161 per dollar. So it's hit essentially its weakest point since 1986. Pretty huge. The finance minister has issued more warnings against sharp moves, and the year-to-date decline is around 14%. And James, how has this affected?
Well, again, if we move on to the next chart, I've brought this chart up before. It's the currency dollar yen here against the 10-year interest rate differentials. The bond curves, the US bond curve against the Japanese bond curve. G10 currencies, the primary mover is interest rates. But as you can see here now, there's increasing concerns that this is actually just a yen currency crisis. You can see how the correlations work so well in the last few years, but it's broken down in the last 3 months. Dollar yen has continued to trend higher. The market's very long of dollar yen, and the algorithms, trend following algorithms, are very long. But the yield differentials have turned. So what could steady the yen here? Well, really, the problem Japan has is raising rates. They have so much debt owned by the central bank. They're going to struggle to let the 10-year yield move higher. We know they've been doing quantitative easing to prevent it moving higher. There's talk, and it's priced in the OAS, of one more hike this year. They may bring that hike forward. But really, in my view, this comes down much more to US data. And to see the dollar yen move lower, we would need to see much more aggressive pricing of Fed rate cuts, which really brings us back to Friday's data. We have a lot of employment data this week, the JOLTS index, sort of secondary data, ADP, initial claims, continuing claims, but Friday's the big one. Non-farm payroll expected to be 190,000 jobs created and 4% unemployment. But we keep talking about this. Underneath, we're seeing more and more weakness. The last year, we've seen 1.3 million full-time jobs lost, jobs being created are part-time, but we haven't yet seen the headline number really come in weaker than expected. Your thoughts, Harry?
I'm tempted to agree with you on that as well. I think with dollar yen, it's really, really hard to see a situation where the Bank of Japan does anything major. So it's going to be extremely reliant on what happens in the US. And as you said, weakening data and maybe just a few bad data points is all it needs. We'll really start to see that the differential come down.
One key point from a trading perspective, though, of course, is dollar yen is trending higher. If you are long, there's a threat. We've seen intervention by the Ministry of Finance in Japan, hasn't succeeded. The other threat, of course, if you see coordinated intervention. But if you believe that the correlation will play out in the longer term, then there's time to wait to see dollar yen actually fall before you can get on board, because this is pricing dollar yen with a one in the 140s, where it's trading now at, as you say, 161.
Yeah, and moving on to something else that's been extremely interesting, especially in the last day, is the French elections. The first round of the French legislative election was yesterday. The result was as expected. Marine Le Pen's Rassemblement National party came in first place with around 33 to 34% of the vote. The left-wing NFP alliance came second with 28%, and Macron's Ensemble coalition is somewhere between sort of 20 to 23%. Quite a sort of significant thing about this election. The election last time, or in 2022, the turnout for the first round was about 47%. This time it's 65%, so really a huge increase compared to normal. Generally the legislative elections in France don't get the same sort of turnout as the presidential elections. And significantly, what we can say from this straight away is that Macron's party will be a small minority in parliament. So they'll go from their current level of around 250 seats to sort of a maximum of 120, 130, and that's being pretty generous. Essentially meaning that the left-wing coalition and what the media essentially refers to as right-wing, far-right, the Rassemblement National will have the most seats. And on the 7th, so that's the second round, we're going to see a lot more runoff elections. So in France, it's a bit more complicated than the UK. You need 12.5% to get through to the next round. And I think in the last election, that only happened in about, I think it was 6 or 8, the French equivalent of constituencies. This has happened in over 300 this time. So far more competitive. And the main thing to watch out for is how coalitions form. So Macron's coalition are absolutely dead set on keeping the Rassemblement National out of power. So it'll be fascinating to see if they try and work with the left wing, if they try and even get votes from the Republicans. But potentially, yeah, this has huge ramifications for Europe. And as the following chart shows, it's already having an effect on markets. So markets were really pricing in uncertainty from last week and the week before, but they've slowly started to sort of account for the fact that the Rassemblement National will be in government or will have much, much more power going forward. The CAC 40 futures index rose by almost 3% this morning, as the chart shows. 10-year government bond prices edged up, pushing yields down by around 2 basis points. And the gap between the French 10-year and German 10-year bonds narrowed by 7 basis points to 72.8.
But isn't today's move a bit of a relief that Le Pen may not get an overall majority? What's happened for the last 2 weeks? We've seen the euro selling off, we've seen French bonds selling off against Germany, and the equity markets continue to weaken. How do you see this playing out in the longer run?
I mean, I think the markets are I think they're actually more scared of the left-wing coalition coming to power, given their spending plans and given their plans for taxation. They plan on essentially raising revenues by about 150 billion euros by the next presidential election. That's what I think the markets are more scared of. Like the left-wing coalition contains a lot of parties that are typically very hostile to markets. Also, like the deficit will probably not be in a healthy state. As me and Harry spoke about last week, the Macron's coalition is the only coalition that's really focused with bringing the deficit down, and they treat 3% as their target. Whereas for the other two sort of main players, we could see the deficit keep going up from 5-6%.
So I'm guessing from a trading perspective here, we're going to see more volatility around the headlines, the elections, which
absolutely
makes trading harder.
And it all depends on who can form the coalitions over the next week, where Ensemble voters end up putting their vote. Because there are talks of Macron's coalition even standing down candidates, which is crazy for what's been the governing coalition for a while. But he basically potentially plans on standing down some candidates just to make sure that the right wing, far right don't get in.
He's created a real mess, that's for sure.
He really has. It's hard to see why he did it unless you take into account the fact that he thinks if those two parties or coalitions do get in, they'll get people to hate them so much in the next 3 years before the presidential election that his sort of centrist coalition will look better. And onto OIS pricing.
So central bank pricing, we've had overall some more weaker data last week. You can see, particularly here, the market's pricing 17 basis points of cuts at the September meeting. And if we can actually move straight on to the next slide, you will see 17 basis points September meeting, 25 basis points at November. So the big question in the US, when will they cut and how aggressively? Plenty of people think they won't cut until inflation is down to 2.0%. So different ways you could actually trade this. One is you think if the Fed are going to remain higher for longer, they're not going to cut as the OIS market is predicting. Then you could, as a currency trade, you could be long the dollar, but of course then you're playing it against which currencies you play against. You could do a bond trade. You could be selling the 2-year if you think yields are going to stay higher for longer. But the other way, if we look at the OIS, which of course is this built off the Fed funds futures products, you could do a curve trade. So you could pay the 6-month OIS, which means you're going to get the benefit of the Fed not cutting what's priced in, and then you could receive 1 year forward, so 6 months to 18 months. So you're paying the front of the curve, receiving the back of the curve. If you expect they won't be cutting rates this year, they're more likely to cut more aggressively next year, then you would make on both sides of the trade. So it's quite an interesting trade there. If we move on to the next slide, the Australian OIS. So what we've had in Australia, the Australian central bank only hiked to 4.35%. They haven't moved this year. Other countries, the US over 5%, their big trading partner, New Zealand, is over 5.5%. The Australian central bank were less aggressive, and now they're kind of being punished for it by the market. The inflation remains stubbornly high. And you can see here, this is the OIS, what's priced by the OIS by year end. So you can see at the beginning of the year, the market was expecting the central bank to cut 60 basis points. But if you fast forward to the last 3 months, the market's pricing hikes, cuts, a hike again. So the market is basically moving around zero, whether they'll need to hike or cut. From a trading perspective, makes trading very hard. And I think, again, the central bank's being punished for not raising rates as aggressive last year.
Yeah, I think, as you were saying, the Australian CPI data, where it was expected to fall from 3.8 to 3.6%, but actually rose to 4%. It just means, they're sort of in limbo. How can they effectively respond to it? Just given how it's been.
Yeah, we're pretty certain the other central banks are going to be cutting. It's being priced into the market, but here the investors are left completely in limbo, not knowing whether it's going to be a hike or a cut. They may be forced to hike one more time. They have an extremely strong housing market, which would be impacted pretty hard. Again, time will tell. We'll see how the data plays out in the weeks ahead.
Definitely. And sort of building on inflation data in Australia, 3 major EU economies had their inflation figures released from June last week. So France, Spain, and Italy all had their data released. France, if these figures came out before a normal election, where the governing coalition weren't already predicted to lose so many seats, this actually might be quite a good thing. So their rate of 2.1% was far lower than the expectation of 2.5%. And also lower than the previous of 2.3. So an increase was expected, but a decrease was actually seen. In Spain, we also had a decrease from 3.6% to 3.4%, although that was slightly less than anticipated, given the 3.2% expectation. Also in Spain, we had producer prices released last week. So they fell 4.6% year on year, marking the 15th consecutive month of producer deflation. Pretty huge there.
And this is a good important point, is that PPI typically leads CPI. As input costs fall, then businesses are forced to pass them on, especially as demand falls. If we start seeing weaker data, demand falls, then businesses are forced to cut prices. So typically PPI does lead CPI.
Absolutely. And we also have Italy's data. So their inflation rate stayed stable at 0.8%, despite an expectation of 1%. And it's going to be interesting going forward. So Italy is predicted to have the lowest inflation of any G7 country, I believe, for the next few years at least. It's really hard to see how they're going to get out of their current, how that had ever really increased too much and how their GDP growth is going to significantly increase. So Italy has, you could say, the worst demographic situation of any country in the G7. They're aging faster and they're just further along that process.
Sounds a bit like Japan to me.
Very similar, actually. Japan's maybe just slightly further along. Crazy stat I came across this week was in 1950, there were 17 under 10s for every over 80 in Italy. That's now 1-to-1, or it's just approaching 1-to-1. So as you see this fundamental shift in essentially how societies operate and how pension systems operate, what happens to economic data? And deflation, or at least much lower levels of inflation, are one of those symptoms, especially in the short term.
Again, it reminds me, India's a standout economy at the moment. Economic strength, PMI is surging, and great demographics. Interesting point on these European inflation figures. With inflation falling as aggressively it is, and we're starting to see weaker data, German IFO, business sentiment, for instance, we're just looking, when will the ECB be cutting next? That's now a trend. Personally, I think we see more cuts from the ECB. I'd be happy to receive the OIS curve at these levels. And then the impact on the currency. Euro, you've got volatility at the moment with the elections, but again, I'd prefer to be a seller of euro dollar. On anything else, the economic data certainly seems to be much weaker in Europe.
I think, it's almost quite refreshing to have examples of some countries which do actually have rapid economic growth, and I don't believe there's anywhere in the world that's more extreme with that currently than Guyana. So Guyana has become an oil producer recently, and the sort of major development there is the Starbroek field. So it's set to enrich Guyana enormously. Exxon, in partnership with Hess and CNOOC, have already invested $55 billion in producing oil from this field, in what the Financial Times referred to as potentially creating the world's last petrostate. The Starbroek field is 11 billion barrels of oil and is about 120 miles off Guyana's coast. Guyana's GDP actually expanded 33% after inflation last year. The GDP is more than tripled in the last 4 years. And for the government and for the citizens of Guyana, it could be absolutely huge. So just between 2024 and 2040, the government's expected to receive a windfall of $150 billion. And Exxon and its partners are also expected to receive about $135 billion. So you'll start to see a lot more Guyanese oil enter oil markets, but also, something to potentially watch out for on a geopolitical level is, as the chart shows you, there's the Essequibo disputed territory. So Venezuela has been extremely, has been fairly clear about its desire to take a bit of Guyana. And obviously, given where the reserves are, where some of them are actually closer to the coast of Venezuela than Guyana, that could be a potential flashpoint. But I mean, hopefully nothing too major happens there. And moving on actually to equities. So Airbus and generally aviation stocks have been an interesting one to watch in the last few weeks, but particularly the last week. So as people know, Boeing haven't been doing well recently at all, given safety concerns, given, a number of factors. A lot of people believe it's in structural decline, but other people can decide that for now. I'll form my view. But Airbus shares fell 10% amid persistent supply chain issues last week. Whilst Boeing's problems seem more sort of severe and more reputational based, Airbus has really, really strong demand, but just can't keep up. So their deliveries, they've had to revise down their delivery target for 2024 from 880 to 870. Well, despite the fact that were their supply chains completely in good condition, you'd see those orders be very high.
I think it's also a good reminder that equity prices can go down. We've seen the last few weeks, was it the 2.5 months, the Nasdaq's up nearly 20%. S&P's going higher, keep reading about Nvidia. Share prices don't go up forever.
Sadly not. Well, okay, it also depends when you put your money in.
That's the key. For long-term investing, it's all about when you go in.
If you put all your money in what, about 2006, 2007, and then got out in 2009, you'd be...
March 2020, March 2009, it's all about, for long-term investing, it's all about when you go into the market.
But I think that you end up needing a retracement at some point. Otherwise...
It becomes a buying opportunity unless you're long and you hold it on the way down.
Completely. And another example of a stock that's really rallied in the last week is EV firm Rivian. So Rivian has a contract with Amazon and they've released a lot of cars which have really fantastic reviews. So I wasn't really aware of just how they were doing, given they're not really a fixture in Europe. They're far more US focused. But they're bleeding money. So
how much?
A lot.
Horrific.
So $39,000 per vehicle currently is how much they're losing. So whilst this sort of loss leading model was at least more sustainable during COVID, where interest rates were extremely low, you just can't do that in these sort of times of higher levels of interest.
But Rivian, along with Lucid, the electric vehicle companies, they were part of the lockdown boom, weren't they?
Exactly.
So I remember I talk about it in my behavioural finance training, where Rivian and Lucid had a bigger market cap than Ford. Even though Ford sells 4.5 million cars for profit, Rivian and Lucid at the time had not sold a single car. This was about December 2021. And since then, I mean, you've only got the short-term chart of Rivian. It fell, I think, over 90%.
Oh, huge. I mean,
But now it's going back up again.
Well, rose 30% on the news that VW are to invest $5 billion. So it's not actually a singular investment. It's $1 billion up front and then $2 billion, I believe, in by the end of 2024, and then another $2 billion by the end of 2025. But outlines VW's commitment to EVs, whilst some companies are sort of scaling back that what would you call it? That sort of conviction that EVs are going to be their future for the next couple of years.
Yeah, I just keep reading about the Chinese electric vehicles and how much they've penetrated European markets and prevented European cars selling in China.
Yeah, it's just that whole pivot from internal combustion engines to electric.
But it seems like China's just taken over the electric market.
Yeah. I've got a chart actually, which I should have included, but it basically outlines where each major car manufacturer has their customers. So who relies mostly on China, Europe, US, especially the German car companies. If they can't manage to make up a good market share in China with their electric vehicles, they're going to really suffer. Because some of them have 30-40% of their market share in China.
That's another problem for the German economy.
Certainly is. As we know, everything's weaker coming out of Germany, and I don't think that's going to help.
Another reason to sell the euro.
Exactly. Or a stock that, a European stock that you could have been quite bullish about and potentially still could be quite bullish about is Ferrari. So the largest listed company in Italy now. They've expanded enormously since going public in 2015. Their price has gone up by around 10 times in the last 8 years. And they've really they've successfully managed this transition from, lower volume, lower variety to higher volume, higher variety. Whether that's sustainable or not for the near future is up for debate. So if you're a company like Ferrari, they've managed to increase their sales by 60%, just the volume of cars produced, since 2017. How much can you do that as a luxury? I mean, this could apply to LVMH, this could apply to Hermes.
Watch out for the recession. When?
Yeah.
If.
If you're currently relying only on increasing revenues and looking better for investors by increasing the price of your products, surely it can't take much in terms of a recession or any sort of contraction to reduce demand more. And as depreciation starts to be a factor for an increasing number of their cars, just because of the increased volume produced, again, that's something else to watch out for. If they're no longer purely a good investment, why are you buying them? And onto the final sort of, but I believe the biggest talking point from last week, the US election. So the US presidential debate happened on Thursday. I'm sure anyone that's watching this has seen countless number of clips from that. You could say if you were a Democrat, you'd probably say taken out of context, but if you're a Republican, you'd definitely say taken in perfect context.
How about you as a neutral?
So I watched the first half an hour and I was wincing. It was just, I've heard that was the worst half an hour. The start was the worst part. But
even so, how could Biden stand? How can the Democrats support him?
It just raises questions on, well, if you're a Republican, you'd be arguing he's obviously been getting worse for a long time, but this really was, I think, the first time where, for an extended period of time, you're watching and thinking, please, like, who's put him up to this? Like, who's okay with this?
Personally, I can't believe he'll stand, and I'll be more concerned about whether he can see it through to the end of this term.
Yeah, I mean, yeah. Even if you watch videos from 4 years ago, he at least seems a lot more coherent. And yeah, if 81 already, but like, what's going to happen by 85? So I'd say increasingly look at who he could be replaced by. So it might be Vice President Kamala Harris. It might be California Governor Gavin Newsom. As a neutral, I'd say, I mean, a lot of people are skeptical of his record in California, given how a lot of people have begun emigrating to Florida, to Texas, and their economies, it's not stalled completely, but it's not growing as quickly as, especially these major Republican states like Florida, Texas. So yeah, the sort of a few candidates to watch out for, and who knows what the Democrats are going to do in the next few months.
Is Michelle Obama an option?
I have heard that, yeah. I'm not sure how that'd work. So, I mean, internet speculation was talking about how Democrats knew this, well, the broader party knew this was going to be a thing, so move the debate forward as much as possible to, well, show that if Biden's in a bad mental state, it's revealed as soon as possible. So
There's
that they've
still
got
time.
Yeah. So yeah, by mid-August.
And looking at this, obviously the market's suddenly pricing far better chance of Donald Trump becoming the next president. From a market perspective, one thing of it, the highlight or issue with that is he's looking to pose 10% tariffs. And what's that going to do to, firstly, inflation, but then world trade and trade disputes with other countries?
Yeah, it was just a hard watch, to be honest, watching it, because whilst Biden might have been at least very incoherent at times and seemed sort of a bit lost, I can't remember anything of substance that Trump managed to say. It was like when I was in power, we had the safest border, nobody came across, whereas now, like, everyone's coming in, things like that. And it's really hard to think about what's actually going to happen if either of them are elected, really.
All about elections and the UK election this week as well.
Yeah, absolutely.
I think that's the foregone conclusion.
It's
but
just,
who knows, any surprises?
I mean, it's just who ends up. Can the Tories remain the second biggest party in Parliament? So if they stay in opposition, and if they're the main opposition, then I guess, yeah, you'll see less of a. I think you'll see less of a change over the coming years, given the advantages that get given to the second party. But if they don't, and if the Lib Dems do better than expected,
more and more people who want a tactical vote. They're always been conservative supporters, but just had enough of the debacle of the last few years. So they're going to vote. Well, they're not going to vote for Labour, so it's going to be Reform or Lib Dems.
Yeah, I think with Reform as well, they're just taking votes from the Tories everywhere. Even if it's feasible they end up with no seats, but I think I saw a projection that saw they might get 19. So For them, that'd be huge.
Yep.
But for the Tories, it's even worse because it's just 15% less in virtually every seat, apart from Clacton, but who knows what's going to happen there. And yeah, on to the chart of the week.
Chart of the week. We mentioned that the Nasdaq has had a huge move up nearly 20% in the last 2.5 months. And actually, interestingly, US equities, the best 2-week period of the year is actually the first 2 weeks of July. So we're right into it now. But you can see what you had on Friday, you had a big reversal candle. Actually, the 8-day moving average, I like looking at that. It gives me some idea of what the CTAs might be doing. That is just starting to reverse. And the key level here, the long-term trend is higher. But we had a pullback last week and the low at 17,500. It's the key of what breaks first. If that breaks, then you'll see stops triggered and you'll see a retracement as people take profit. 20% in 2.5 months is a huge move. But to resume the uptrend, it needs to break last week's high back at 17,936. I say high, the double top there. So interesting point, it's failed to make a new high. If we see last week's low get taken out, then you start to see a short-term downtrend. So the key level in the Nasdaq Composite Index, keep an eye on 17,500.
Absolutely. And I guess, just looking at the list of key data releases for this week.
It's a really busy week.
It's a very busy week. I think you'd agree with the biggest potential player for markets would be Friday.
Without a doubt, non-farm payrolls. We mentioned earlier, we have some other secondary employment indicator coming up to that. But also today we have US ISM manufacturing. And then on Wednesday, we have US ISM services. They're pretty big.
We've got Eurozone CPI data on Tuesday, but obviously given we've already had results from major economies last week, it's unlikely that will be particularly surprising. But a really rogue non-farm payroll bit of data could significantly swing the market.
And it keeps surprising to the upside. While the secondary data comes in weaker, the payroll surprises to the upside. Can it do it again? We'll find out Friday. Again, that has the potential to be a big market mover. I remember when you've seeing markets expecting about 180, 190 to 200,000 jobs before, and it's come in negative. You've had huge moves in the bond market, which then affects, of course, the currency equities. But again, we may just be again to the upside, but we're seeing increasing chances of volatility here.
You might.
I remember, I learned the hard way. Always remember to wait for the data and then trade it. Trying to predict and trade in front of the data, it's a binary outcome. You're either a hero or you get absolutely flattened.
So we've got a huge amount happening this week. We've got a lot of data releases. We've got the UK's general election. We've got the second round of France's legislative election. And we've also got England playing on Saturday. So have a great week.
Thank you.